Hello, ladies and gentlemen. Welcome to yet another edition of Thought Leaders Chat with Ochieng Olo. Today, my guest is Mr. Martin Mugambi, the Chief Executive Officer of Citi Kenya and banking head. We're going to be talking about the bank's performance over the last 1 year and the direction going forward. So welcome, Mr. Mugambi, to this chat.
Thank you, Ochieng. Good seeing you again.
Nice to see you too.
Good.
I guess this has become a ritual. Every year we have to meet and sort of discuss what's happening in the banking sector and, of course, generally the economy.
Yeah.
So let me start by putting things into context. Citi was this year's overall winner of the Banking Awards, I think Business Banking Awards 2025. And congratulations for that achievement. I mean, I think this is the second year running. You won it in 2023, in 2024, and now 2025. And I think in 2024, you were also the Chief Executive of the Year. And congratulations once again. Now, let me just first ask you, why do you think Citi stands out amongst its peers in terms of your performance, not just in the awards, but generally?
Thank you, Ochieng. And first of all, let me appreciate business for the partnership we've had and yourself for the honor you've bestowed on us again in winning that award as the best overall bank in 2025. We take a very concerted effort to be relevant to our customers. We also try and innovate in the way we do business. We try and respond to our customers' changing needs. And we also try and run an efficient business. The various metrics that went into your evaluation of Citi tell the story about how we run our business. The focus on controls, the focus on also just making sure we support the growth of our customers in their various cycles. And I think the combination of those factors is what distinguishes Citi. And, in a bank market, in a market where there are 38 banks, 38, retail, commercial, institutional banks, to be voted as the best overall bank is a very big honor for us, and we don't take it for granted. And to really, close the response, I think it is a reflection of the values that we hold as Citi, of being relevant to our customers, solving their problems, and also growing them. That's really what I would want to say.
Mm-hmm. Thank you. Now, our theme this year was on financial literacy. I know from where you sit as Citi, that's probably not the biggest of your problems, yeah? Because a lot of your customers are people who generally understand how the financial system works and are very good at what they do. So I just want to find out from a broader perspective, yeah, and given your experiences elsewhere. I know there are banks where you actually bank the common man, the individual, not the same in Kenya. But looking generally at financial literacy in Kenya with regard to the banking sector, how would you rate it?
Thank you. It's an important question, and it is a relevant question for us as well. I think what you'll see is that the level of financial inclusion in Kenya is fairly high. It's north of 80%. It's certainly much higher, and it has been made possible by the fact that Kenya has a fairly strong, what I would call mobile banking platform that allows for a significant percentage of the population to be banked, not necessarily bank accounts, but to have financial options. And they're part of the financial system through digital mobile platforms, which allows them to partake in financial services. So the high level of financial inclusion is reflective of the fact that financial literacy is also high. It's not where it should be, but the fact that you've got a population that is able to be part of the financial system through their mobile platforms. They've got mobile wallets, which are proxies again of bank accounts or accounts that hold value. They're able to transact, whether it's to make payments, to consume financial services, different types, savings, get healthcare cover, and do various types of transacting from a business or personal perspective, demonstrates to me that financial inclusion in Kenya is not only positive in terms of where it is, but it is also growing. Yeah? So that's important for Citi because, as you have correctly stated, while our customers are large corporates, some of them multinationals, some of them local corporates and organizations, what we also look at is the ecosystem around our customers. And those may not necessarily be the same size or the same level of capability. So that level of inclusion is important for that ecosystem. So for instance, the suppliers or distributors of our customers tend to be SMEs, a lot of them, a big percentage of them, and also just businesses that are organized around small companies and individuals. So it is important for us to look at that ecosystem and to see the level of inclusion, and that also defines on how we support our customers, bearing in mind that they have to work within that ecosystem and they have to support that ecosystem to be successful in their own businesses.
Mm-hmm. Is there a way that you actually reach out to the suppliers on that ecosystem from a financial literacy perspective?
So what we try and do through our supply chain financing programs is essentially make sure that the suppliers of our customers understand the options available to them in terms of getting capital, in terms of getting working capital. We don't work with everyone. Obviously, it is not that we try and be everything to everyone. But where we've got suppliers and through our supply chain financing programs, we have very specific literacy programs first of all, to teach them about the options available from a supply chain financing perspective, how they can benefit from those programs. For instance, we've got specific programs focused on women-owned businesses, and we have very tailored solutions for those supply chain finance options. So yes, literacy for us is important, but it is obviously connected to our broader customer base and our broader ecosystem around how we support them.
The financial sector, even more specifically the banking sector in Kenya, is evolving quite fast.
Yes.
And as you were pointing earlier, there are new trends emerging, or there are trends emerging going forward, of course, as a result of the changes in the economic environment. I mean, how do you describe some of the changes or the experiences that the banking sector is having right now?
Good question. It's always exciting to see the developments in the financial sector, particularly in Kenya, where we've got a fairly high level of digitization, where we've got essentially all banks having a clear mobile strategy, digital mobile strategy. The fact that you've got a very hyper-connected banking system between banks and non-banks, or shall we say the telcos, is also very, very, very exciting. We've got, a good portion of our GDP that is transacted on mobile rails, north of 75. I would call it probably closer to 80. That's transacted on mobile rails on a daily basis. And that then talks to the level of innovation. Before it was just an issue of, payments, right? But today that has transcended well beyond payments. Today you can save, you can invest, you can, buy insurance, you can get financial services from your mobile handset. And that's a whole new level of financial services that has evolved. So what we continue to appreciate is the level of innovation that continues to move at pace. beyond payments. And that's important for any bank, whether you're a retail or a corporate bank, to have a digital mobile strategy that allows for flexibility in how you serve your customers and their ecosystems. The second trend I want to point out is the emergence of artificial intelligence in how banks and financial services players are now embedding AI into their business models. This will transcend the usual, chatbots or bots that focus on customer service or customer engagement to a lot more nuanced platforms. Let me give you a good example. When we talk about generative AI and agentic AI, as we move towards, AI agents that actually perform functions. Today, you've got banks that are already embedding AI on whether it's risk analysis, on whether it's screening transactions, high velocity screening of transactions, fraud management, again, managing high velocity of transactions and picking out trends that could pick out, trends in fraud. So fraud management, today, KYC onboarding, again, has a component of AI embedded in it that now allows firms to undertake tasks that are routine in a lot more efficient, in a lot more structured way. And you also have an evolution of AI to now agentic AI, which is allowing for systems to actually undertake tasks without very heavy oversight, very heavy supervision. And that's important. It's an important development because it's not just the banks, but the customers of the banks are also undertaking transformations in their own systems to embed AI, whether it's Gen AI or agentic AI. So what you have is an evolving sector that is slowly adopting AI into how it does business. It also comes with some risks, obviously, and it's important to have the right guardrails, the right protections, compliance platforms to make sure that you are using it in an ethical manner and in a way that serves your customers. There's a regulatory angle around it as well, and that is something that the regulators are also looking at in terms of how to look at the risks that these AI platforms pose to customers, to the institution, and how you govern those risks. So what is clearly the trend, as we've seen in Kenya, is a high level of digitization. And I think I talked about the mobile digital business models, but also this now next trend around utilizing AI to run your businesses, embedding AI in your processes to run what was previously maybe very manual processes. Now those are becoming automated. They're automated with a lot more intelligent systems, and firms are putting a lot of capital into this. There's a lot of investment going into this sort of platforms to make sure that you don't fall behind, and you're also responding to the fact that your customers are also investing in AI platforms. So those are the two areas I would like to sort of highlight as we continue the conversation.
Now, from a business perspective, a lot has changed in the Kenyan economy, and of course, interest rates have stabilized. Even the exchange rates have stabilized. These obviously have an impact on the banking sector and how you in the banking sector conduct your business. What has changed, particularly for Citibank and of course also for the rest of the industry?
Okay, so it's a great question because as we go towards the tail end of the year, you start to notice that interest rates have certainly come down from where we were, 12, 18 months ago. We had, for instance, the 182-day T-bill at 17%. Today that has come down and we're at 8%, 8.1%, right? We have had the central bank rate also reduced by 325 basis points. Today, the central bank rate is 3.5%. Inflation has also come down significantly to 4.1%. So what you have seen is an adjustment in some of the monetary metrics, certainly on the interest rate side. And that has an impact, obviously, for banks. Most of their interest income, whether it's their lending to customers or lending to the sovereign, is pegged off, whether it's the 182 or 91-day T-bill for facilities or various base rates for banks in the market, or to the sovereign 182-day or 91-day. Those rates have come down, right? And now they are in most cases, single digit, certainly for the 91 and 182-day, and for the central bank rate. That means that the trend towards lower interest rates is well underway. It is not a matter of if, it's a matter of when banks all adjust their rates. Number two, there's a benchmark review that the central bank is undertaking in partnership with commercial banks in the market. And what will change, and this is an important point, is instead of having the different 38 different base rates in the market where banks were pricing off different base rates, all risk-based credit pricing models from their own institutions, banks will now transition into a common starting point, a common base rate. And that common benchmark, I won't call it a base rate, I'll call it a common benchmark, is one that has been agreed with the central bank, that has been put to public participation, and the banks have also supported it, will be an interbank rate. An interbank rate that will form the starting point for credit pricing. That will provide a uniform starting point for customers, both corporates and retail. And then there'll be this component of a credit spread or credit premium called K. So in the recent past, this was a particular sore point for customers because they felt that the level of transparency was not as high. And with the introduction of a liquid benchmark that is now published and that is open and transparent, that will allow for a lot more transparency in credit pricing. And we believe that it will also spur the uptake of credit because, as I said before, we are going to see a movement in interest rates downwards, reflective of where the current interest rates are in the market. So that's a very important development in the financial services, financial sector, because pricing of credit is central to everything. The third and perhaps last point I want to make is that we've had a very stable currency for the last 12, 15 months, at 129, 130 level, shillings to the dollar. And what that has meant is that we've got a much more stable currency. We have seen less volatility in the currency, and of course, for banks that also have a component of their earnings as a function of the currency trading that they undertake in their FX income, we've seen that spreads are a lot more, tighter, and the lack of volatility has also meant fewer opportunities for banks on the trading side. So as interest rates have come down, we've also seen that the stable currency has also reduced the level of volatility in the currency itself, and consequently FX incomes for a lot of banks, and that's reflective also in some of the numbers that are being published. So nothing negative. A stable currency is good for the country. Lower interest rates are good for the country because they will imply more credit uptake and more affordable credit to consumers and businesses.
Now, let's talk a little more about credit pricing.
Yes.
It's been quite an issue in this market, and a lot of changes over the last, I could say, even just 5 years. Because before that, I think we had there was a lot of move towards risk-based pricing. And I think hardly a year or two since implementation, that doesn't seem to be working well again. And now there's a new proposal from, of course, Kenya bankers and also in discussion with the central bank to change that to what you're now talking about. I think the issue would be, of course, to a large extent, speaking from a customer's perspective, they would want to see a rate that one is very simple and predictable and easy for them to understand. I am not sure that what we have, the new model that you're talking about, do you really think that this is finally it, the one that will work for this market?
It's a good question, Mocheng, and it's important to also underscore that this proposed benchmark has gone through very extensive public participation. You know, in Kenya, we like public participation.
Yes.
It has gone through very thorough public participation. Comments have been received from the private sector, from the public sector, from the banks, right? And there's largely alignment on the proposed benchmark. And I think now it is really a matter of finalization of the last few technical details, which the Central Bank and the Kenya Bankers Association, as stakeholders, are going through. The technical teams have been very hard at work finalizing this model and the operational mechanics of rolling it out and transition from a customer perspective. And I think we are at the very tail end of this process, where now we expect an announcement to the market by the central bank, and thereafter for the banks to implement it through their boards, obviously get their various board approvals, and then move towards implementation in their systems and also from a customer transition point of view. To your question directly, I think this is the right approach, because it's not just a Kenya centric model. The pricing using an interbank benchmark is best practice. It's a global standard. In the US or in the UK or in South Africa, other markets that have been looked at as benchmarks, they also utilize an interbank benchmark. And why interbank? Interbank is really the pricing reference rate that banks use to borrow from each other. And that is a good measure of the cost of liquidity, the pricing of liquidity. So using that as the starting point actually borrows from best practice and reflects what is actually the right direction in terms of credit pricing. Of course, the proof will be in the pudding and the transition, how customers react to it. And the real test is whether customers see a reduction in their credit pricing based on their own credit risk. I believe in the fullness of time that we will see that this is the right direction. So from a Citi perspective, for absence of doubt, we absolutely support this direction.
I mean, one of the main assumptions, if you're going to use an interbank rate, is that the regulator is going to be very prudent. We've been there before.
Yes.
When you had some banks that you wouldn't give the same rate as you give another bank. So the assumption is that the regulatory environment is going to be quite stable as well. And of course, I'm praying for that. Yeah. And I want to ask that also, looking generally at the macroeconomic environment, the stability that we're enjoying with interest at the moment. Do you have, because how you measure also the direction the regulator is taking is whether they're making decisions, even at the MPC, that actually are reflective of the trends in the economic environment, or they are bent on, let's say, pushing interest rates down, and therefore will come up with a figure just so that banks can push their rates down too.
Okay, I think you asked several questions in one, and let me try and unpack it from what I understand to be the main question. The main question, as I see it from what you've asked, is the stability of the macroeconomic environment, and also to some extent the monetary policy decisions that have been taken by the MPC around interest rates. Sorry, around the central bank rate, which is a consequence of where interest rates
Yes,
are,
yeah.
where inflation is, and the broader macroeconomic performance of the economy. I think the
And
last...
then I've also asked about the regulator.
Yes.
There's the regulatory aspect of it, which I think is also very key.
Yeah.
Yeah.
Let me start with that last point first. I think we have a very strong monetary policy committee, and we have a strong regulator that is very well seized of the drivers in the economy. What do I mean by that? Today, when we look at the currency and the stability of the currency in the last 12 to 15 months, it is not by luck,
By happenstance.
by happenstance. There are actually fundamentals that support that. Today, if you look at the reserves in the country, the reserves are almost approaching 5 months of import cover, close to $11 billion. And that is substantive, that's real, it's tangible. That allows the central bank, obviously, to maintain a fair amount of stability in terms of intervening on the currency side to remove volatility. A lot of the accumulation of reserves has also been from the interbank market, right? So it has been a stable, sustainable process that the central bank has followed in building the reserve capacity and the reserve cover to about 5 months of import cover. Number two, we have seen a fairly steady level of export proceeds coming into the country. We have seen a fairly strong growth of diaspora remittances coming into the country. Tourism flows into the country have also been strong. And the sum total of those flows, again, do help our current account position. Today, the current account deficit is sitting at 1.6 times, yeah? And that is a significant improvement from where it was at 3% of GDP last year to 1.6% of GDP, reflecting the strong inflows from a portfolio financial point of view, from an exports proceeds point of view, and from the reserves that the central bank holds. So we don't have a balance of payments challenge, right? And that's reflective of where the current account deficit is, and it's also reflective of those other monetary policy actions that we've seen on the currency side. The third point around interest rate management. Why have rates come down by almost 600-700 basis points on the treasury rates, on the treasury yields? Yeah. And we can have a debate about it, but I think the fact of the matter is that inflation is significantly lower than what it was 15 months ago. Today we have inflation of 4.1%. That is within the central bank band of 5% plus or minus 2.5%. That's the monetary policy target in terms of where inflation is. So it's well within the band. And interest rates on the sovereign side have also reflected the fact that we have got low inflation. We still have fiscal challenges, which is a different conversation. But I think the fact of the matter is that the reduction in rates on the treasury yield side, 182 and 91 day, is also reflective of the lower inflation and also the improvement in the government's borrowing capacity in the domestic market. You may debate and say, Martin, I don't agree with that point. But today we are seeing very strong performances of auctions, whether it's the IFBs, the various taps, reopens that the government undertakes through its fiscal agent. And what this points to is a fairly strong domestic liquidity position. Yeah. And that has managed to bring down interest rates on the sovereign side, on the treasury side. And, the numbers don't lie. Ochieng. Yeah. We can have a debate on anything, but I think the performance of these auctions is reflective of where these yields are today at the respective single-digit level. So I've answered your question perhaps in a bit of a long way, but I hope to have covered the areas that you raised.
Yeah. Let me talk a little about the fiscal side of things. I think we always have to go there because at the end of the day, revenue collection is a very key thing in the government. Because that's the only way the government is able to finance a lot of the projects that it has. Still some challenges, obviously, in terms of collections, And the key thing has always been the focus on growing the net, Do you see any significant advancements in terms of generation of revenue from the physical side?
I think as we go into a new fiscal year, starting July 2025 to now going to 26, when we look at the performance of the just ended fiscal year, June 2025, I think what jumps out is that the country still has to manage a fiscal deficit of 5% odd. I think we closed the fiscal year with a fiscal deficit of around 5.5, 5.7%. So the main challenges for Kenya on the fiscal side remain the ability to reduce the fiscal deficit, which implies that you either have revenue performing, revenue maximization on one end, or fiscal consolidation from the expenditure side. Running a 5.5% fiscal deficit is not where the country aspires to be. The country aspires to be having a lower deficit than the 5.5. And I think in the conversations with the National Treasury, and the National Treasury has also been quite clear as it engages the IMF on a new program to replace the program that expired in March, April 2025, the conversation of the appropriate fiscal deficit is one of the focus areas for that program. And we are of the view that today's fiscal deficit will probably need to trend downwards for it to be sustainable and also to be funded sustainably, right? So we have less of a current account deficit issue and more of a challenge on the fiscal deficit side. The fiscal space that the sovereign is trying to manage is ability to raise revenues in the context of some of the constraints we have domestically, and ability to pass those revenue increases across into the population, as well as the ability to undertake fiscal consolidation by managing expenditure, right? So you have to look at both the revenue side and the expenditure side in order to get to a target fiscal deficit that is sustainable for the country. So in so many words, I think the sovereign continues to focus on addressing the fiscal space that it has. It's challenged on the revenue side, right? And the expenditure has to be very much the conversation going forward. Inability to raise revenues through new taxes or incremental revenue measures means that you've got to look at the expenditure side if you're to maintain that level of fiscal deficit that we're targeting. So I think that, it's not a question of the macros. The macros appear positive. We've got a stable currency. We've got a very low current account deficit. The country will grow at 5.2% this year. And as I talked about the monetary policy side, strong reserves and low and reducing interest rates. So on the face of it, the macros are positive. But I think the fiscal challenges that we've talked about remain. Really, it's how do we manage the fiscal deficit, have a sustainable debt position going forward, and how do you also create jobs, job creation.
You remember that actually the genesis of the Gen Z protest last year, following the financial estimates that were given for the financial year that just ended in June, was really about taxation. It's really about how the government was planning to collect revenue. That phase has transitioned now to a new phase with a new financial estimates for this year. Yeah, that actually the government is running on now. If you look at the proposed budget for 2024, 2025, with the current one for 2025, 2026, what are some of the marked differences that you'd say? Do you think that the issues that may have led to the protests have now been addressed? What are some of the limitations that you think we still may need to look at?
Yeah, and I'll focus my comments really on sort of the high level observations, right? I won't go into the details of some of the proposals because I think that's in the public domain. We feel that the new budget that looks at the 2025-2026 year has taken a different approach in terms of looking at a number of areas. I think there's more focus of revenue administration, right, and also streamlining some of the areas in, say, administration of revenues where there were exemptions or a lot of leakages, or some areas where there were exemptions that could have been addressed differently, versus introducing new tax measures, new revenue measures. So we are of the view that the 25-26 budget and approach is focused more on driving better tax administration and efficiencies, right? Utilization of technology to widen the tax net, as opposed to introducing new tax measures. And that's important because the aim, again, is to make sure that we've got a sustainably funded, budget that also focuses on reducing the level of fiscal deficit going forward, which implies, again, expenditure management, prudent debt management or debt sustainability from where we are today, without necessarily pushing in new tax or tax revenues from tax increases because of the inability of the population to absorb it. It's a very important change, and as we speak today, there's still a process to go. We're just starting the 2025 fiscal year, as it were, and we'll go into 26. It will be something that we will watch closely in terms of performance, tax revenue performance, collections by KRA, the revenue to GDP ratio, and see how that plays out as we go along. Yeah. So none of these are easy adjustments. I think as we go on, the performance of revenue is a very important indicator, not only for the sovereign, but for other external stakeholders, whether it's rating agencies, investors, and official partners as well. So to come to your point, there's a significant shift in approach from the 24-25 budget to the 25-26 budget, as opposed to focusing on new tax measures, on new tax increases. The big pivot is on administration and efficiency.
And I think one of the other things that the government is currently focusing on to generate revenue is a privatization process that actually has been, you could say, revived, because I think for a while that has been dead. Yeah. What do you think of this strategy? Do you think this is the right way to go? I know there are a few funds that are listed, already earmarked for some form of privatization. And there always are a few more on the list. I've seen today there's something about Safaricom, the government thinking of selling shares in Safaricom too. Yeah. How do you see this panning out, especially in terms of generating revenue for the government? And of course, some of these, some of the discussions going on about this is that some of these institutions are actually strategic, and there are even issues in court stopping the sale of some of these of these parastatals. What is your perspective on the government's plan to generate revenue through privatization?
Okay, thank you. For absence of doubt, I won't speak on specific names, right? I'll speak to the fact that privatization of state-owned entities is not a new topic. Privatization has always been an option for the government to monetize, for the sovereign to monetize its holdings or shareholdings in some of these state-owned entities. And whether that privatization is through a listing process in the domestic stock exchange or through the entry of a strategic investor, these are options that have always been available to the sovereign. Why it is important is that it is also another way to raise revenue, to monetize the shareholdings and to get liquidity for the sovereign. So we believe that this is it's not a new avenue. It has been an option in the past. It's just now been looked at with a fresh pair of eyes. The sovereign has certainly indicated to the market, to development partners, to investors that it wants to undertake these options. And I think you will see that as the sovereign tries to diversify the sources of revenue and liquidity away from just only taxes and procuring different forms of debt, you will find that privatization will now play a more prominent role in the new fiscal year. How that plays out with specific assets or specific names is something that we will not sort of comment on, but we do expect it to be one of the levers that the sovereign applies. Will it be successful? Time will tell. Some of these assets are very strong. They are very well regarded. They are operationally sound, and there's appetite for them. So whether it's on an investor side or on the domestic listing of some of these assets, we do believe that this is a credible option that the sovereign will undertake. It will, of course, go through its own processes domestically, whether it's public participation. There are some processes that you've talked about in the courts that will follow its own course. But we believe privatization is a feasible option of raising and monetizing the stakes that the sovereign has in these assets. Yes, we think that that is a credible way to look at how to raise revenue.
Do you think that the local market, the domestic market, has the absorption capacity for some of these assets when they come up for sale? Because it's one thing to obviously have foreign investors snap them all up, which is not a bad thing. But I think that given that these are actually government assets, which essentially belong to the people, one of the best ways to do them is to actually have the local population have a share of some of these assets. Do you think that we have the capacity to absorb a number of these assets when they come up?
Absolutely. I think there is a very well-established privatization framework. There is the appropriate legislation that is in place that also can allow and protect these assets as they transitioned. And I don't believe it's the case where the sovereign will be selling 100% of its shareholdings in these assets. Most of them will probably be partial privatizations, right? To monetize their holdings into liquidity and also to allow domestic investors, institutional and non-institutional, to participate in the success of these assets. So yes, I do believe that there's first of all, there's strong domestic interest, and there's also domestic capacity to participate in these privatizations. Now, the shape and form is a different conversation, but thematically, there's domestic capacity to participate in these privatizations.
Let's focus a bit on Citi, Kenya, and your operations here. You had a robust year in 2024, and I'm just curious to find out, going into 2025, what is it looking like in terms of performance?
Okay, good question, Ochieng. We earlier talked about certain themes that are happening in 2025. First of all, the the adjustment in interest rates. I'm pleased to say that Citi has actually been a very strong proponent of passing on the adjustment in interest rates to our customers. If you look at the average lending rates that are today advertised, not advertised, but are placed in the daily papers on a monthly basis by the central bank from the start of the year till today, you will find that Citi actually has one of the lowest lending rates in the market, and that's by choice. We have purposely passed on the benefit of the rate reductions to our customers. So that has both a positive benefit to our customers in terms of their finance cost, but also it has a resulting impact on our own financials in terms of our interest income. Secondly, you will also see that we are keeping our participation in sovereign auctions steady, right? We're still a very big supporter of the sovereign and its fundraising objectives. We, as you well know, have taken the sovereign to the market early this year, where we took them and were able to place a sovereign bond of $1.5 billion that was used for liability management. And we are also a strong participant in the domestic auctions, on the treasury side. So we are not only a player, right, but we help the sovereign in its funding objectives by the activities we undertake for them on the arranging side in particular. So you will see that as we go through the rest of the year, 2025 will have adjustments, certainly on the interest income side, because of the adjustments in rates that we've passed on to our customers. Most banks, as I talked about earlier, will have declining revenues from their FX business because of a stable currency without very much movement, and the spread levels having been compressed. I think FX incomes will adjust accordingly for most of the banks, not just Citi. But what you'll also see is there will be also a shift as banks rebalance their portfolios and do more customer lending and reduce exposure from the sovereign and drive more client assets. That's a natural consequence of where interest rates are. So we believe that will also reflect in our own performance. We expect 2025 to also be a strong year, but there will be a reduction obviously from last year because primarily of the adjustments in the rate environment as I've talked about.
One would expect that with the adjustment in rates, probably you're having more of your customers coming over and saying they want to borrow more.
Yes.
And of course, that you'd be able to tell. Then again, I think it also depends on how they're receiving these changes in the market. What is your feel? What is the perspective you're getting?
I think you have to be cognizant that there are several trends still in the market that may come to inhibit strong growth of credit. The non-performing loans in the industry is at 17.6% average from the last MPC meeting that the central bank held with the banks. And that being an average rate is still elevated. Yeah. So you will find that banks will be still somewhat cautious and in their credit extension because clearly banks are managing these elevated NPLs and credit extension then becomes or credit risk appetite becomes less from a pure risk management point of view. We also still have a relatively it has improved, but the pending bills on some of the customer segments is still high, and that's been worked through slowly as the sovereign reduces some of its pending bills, whether it's to SMEs or to other types of businesses. The combination of elevated NPLs, some of the pending bills that are still working through slowly, means that credit extension is still in low single digits, right? And for an economy like Kenya that is growing at let's call it 5.5%, we really should have higher credit extension to the private sector. And at low single digit, one of the focus points that the central bank and the banks is very much seized of is the need to improve credit extension to the private sector. Challenges remain, but I think the direction is certainly positive. We'll see a lot more credit extension as we go to the end of the year, and that should start to improve from where we are, but it's still not where we would like it to be.
Let me move you to talking a little more about the geopolitical environment. Globally, obviously, there have been quite a number of changes. I think we haven't spoken since the beginning of the year. Trump in power, and the numerous changes that have happened since then. And of course, there is the Ukraine-Russian war that is still not ended. The impact it is having on the global economy. From where you sit, where do you see these things heading to? What impact do you see them having on the local or regional economy?
Okay, so let's talk about perhaps the most significant policy development from the Trump administration point of view, and I think that's really the tariffs.
Yes.
The tariffs are still, I would say, not yet fully bedded down. We're still seeing some tariffs for some of the significant economies like China. There's been a 90-day extension in implementation of the tariffs as the US and the Chinese continue conversations around where the trade equilibrium will be. China and India and the US, of course, that is still not yet completed. But we've seen for a large number of emerging markets, tariff levels sort of sitting at the baseline 10-15%, right? At a minimum. Kenya is at 10%. So if we look at the bigger global picture geopolitically, not all the tariff discussions have been completed with a significant economies. I think other than Europe that has got into some sort of tariff agreement and trade sort of meeting of the minds, and perhaps the UK, some of the larger economies have not yet gotten to that point, right? And I think I talked about China and India and others that are still in the process. However, we've seen since the earlier announcement, and I think the initial announcements of baseline tariffs of 10-15%, some of them have come to settle at that level. And the expectation for us, specifically speaking from a Kenya perspective, Kenya will be at 10%. So from a Kenya perspective, that is not going to be a significant impact. Yes, it has an impact, and I think the estimation from the central bank was about $100 million of impact from a Kenya perspective. But with an economy size of 120 billion, which is today's Kenya's economy from a GDP dollar equivalent, the $100 million of impact is not significant, right? And it's important to put that in context. So yes, it will hurt some exporters to the US, specific industries, whether it's textiles and others, but relative to the global picture, Kenya's tariff at a 10% baseline is really not something that we should be very worried about. I think that the country has the ability to absorb that and move on and operate with its stride. However, I think the challenge that you raise around the geopolitical happenings, where does the Russia-Ukraine
and the
situation
constant flip-flops
end,
over those issues?
There is of course, a very well publicized initiative by President Trump to try and bring peace to those two warring entities or countries. And we think that the market and the general view is that that direction is positive. Where it comes out, we wait to see. But I think there's an expectation that there will be a development towards some sort of cessation of hostilities. Now, that is yet to come to pass, but I think that is the expectation. Again, the flip side of the coin is we continue with what has been happening for the last 2-3 years on that conflict. So that's a geopolitical issue that everyone is watching to see how it plays out. Then, of course, the tariff issues that I've talked about, those are the biggest sort of policy administration issue that we are watching on the Trump administration side.
I know. I mean, a lot of these geopolitical issues, actually, the biggest impact is on the supply chain, the global supply chain. You're a major player in that. I mean, even regionally, yeah. And I just wanted to probably talk a little about the role that Citibank plays in fostering cross-border trade, not just locally. I mean, both locally and globally. Yeah. I mean, what role do you really play? Yeah, and the impact of that, of course, to your business.
So it's a big question. Supply chains are obviously going to shift and have started to shift as we've seen the impacts of the trade war, or shall we say the trade conversations that are happening, particularly the China and the US. We expect that a lot of the global supply chains will continue to shift. Why do I say that? We believe that as these manufacturing locations go through different tariff levels, supply chains will have to adjust accordingly. And that is not to just say it will be one-way movement from one large supply chain manufacturing base like China to another one like India, but what we'll see is optionality, and global firms will start to look at different supply chain options, and that I think is a natural trend, and we've already started to see that. And I think as that happens, Citi being a global firm, being a global bank, we're in a very strong position to be supportive to our customers as they shift those supply chains and as they look for banks that are able to support them from new locations, new manufacturing locations as they shift. So those trade flows are going to obviously continue to evolve as these tariff conversations evolve. And what we believe is that this is a natural area where Citi can be supportive to our customers. So looking at a global network point of view, I think that's one of the strengths that the firm is able to bring to its customers.
Let's talk a little about sustainability and green banking. Citigroup pulled out of the Net Zero Banking Alliance. I think that was towards the end of last year.
Yeah.
And I think there are a lot of questions therefore on your commitments to the ESG principles. Yeah. How would you explain that, or what is the direction that Citi is now taking that is different, if not better than the alliance that you are in?
So important to, first of all, clarify for absence of doubt. Citi has not changed its global commitments to be, to meet its net zero targets by 2050 for our client, broader client business, and also to be net zero for our own banking operations by 2030. Those global commitments remain, and they still monitored, and we still report on them annually in our sustainability report. You would also remember, I think we had this conversation a year back, that Citi has made a commitment of financing raising sustainable finance for both social and environmental uses of $1 trillion by 2030. Where we are today is about halfway, about 500 billion of financing has been raised and documented and is available publicly, right? So those commitments to be net zero for our own operations, to be net zero for our broader client business by 2030 and 2050 respectively, globally, are still there. And that commitment towards sustainable financing of $1 trillion by 2030, still there, and we're halfway through. I think what you'll see is that there has been what I would call changes in how we characterize some of these things. Most firms may not call it ESG. They may call it something else. They may just call it sustainability, right? And whether it's for social, environmental, it's towards the same goal. The exit of Citi from the Net Banking Alliance should not be construed to mean that our goals and commitments towards net zero, being net zero for our operations and broader client business has changed. Those are still there. And I think it's just an adjustment of what institutions, what organizations we belong to. But it does not mean that those commitments we made to our investors publicly have changed. They have not.
Okay, I think that is very well explained. What I would want to now ask you as we conclude, looking ahead, not just over the next 12 months, but maybe even a lot more long term. And I'm thinking of this within the context of the changes we have seen in the local and the global economy, at the macro level. Yeah, what are some of the things that Citi is looking at? What do you expect from Citibank over the next 2 to 3 years?
Good. Thank you for that. I think what you'll see for us here, let me start locally, having celebrated 50 years here in Kenya, is that we will continue to double down and invest in our customers, support our customers through the different social or economic or cycles that you've talked about. Cycles come and go, right? Macroeconomic cycles come and go. We have an election in 2027. It will come and go, right? Nothing will sort of scare us away. We've been here 50 years, we'll be here another 50 years plus. So I think what I want to first say is that Citi has had a very good run in the Kenya market, and we will continue to invest and grow. Kenya is now a hub for Citi, and we'll continue to invest in this hub, both by the talent that we are bringing on board, by the systems that we are putting in place. And I've talked about, AI and all the digital platforms that we are investing in globally and at a Kenya level. So Kenya remains a very important country, and it is key for us at a network level, because it is now not only a business, but it's also a hub that supports other Citi entities. Number two, there will be a lot of what I would call shocks and bumps along the way. Globally, we don't know where these tariff conversations will end, right? There will be volatility as some of these adjustments are made from the various countries. We are hoping that some of the geopolitical conflicts will trend downwards, but that's not the case. It has not been the case for some of the long-running conflicts, and those may evolve in different ways. Yeah, so we should continue to be expecting global shocks, whether those come by way of some of these conflicts, the geopolitical developments, the policy developments, or even currency shocks that are occasioned by events around some of these conflicts. Again, a good example is oil price shocks. Yeah, that can transmit themselves into the economy here. We're an oil importing country. It has impact on us if there are shocks that emanate outside from these geopolitical happenings. So the way to answer this question is that Citi has gone through a very significant transformation. We continue to get to a position where we are now a much stronger bank in the way we operate, in the way we support our customers, in the way we react to events, global events, local events as well. And for us, the priority is always our customers. How can we be here for them, and how can we also present opportunities for them to grow their businesses? At the same time, we are also presenting opportunities for our people here to grow. Here in Kenya, as I've talked about, we are building a hub that gives me and my staff an opportunity to also grow in our careers from Kenya, right? Without necessarily moving. So I feel very confident about where we are. The changes the organization has made from a transformation point of view, but also investing for the future. Some of the conversations we've had around AI are very exciting. Very excited to see what comes next, how that develops, how it helps our business, and how it transforms how we support customers. So in conclusion, we have had a good 50 years. Now let's see what comes next. I think the future is very, very exciting for us.
How do you talk a little about the hub you're talking about? I mean, just put it into perspective. What is this that is happening around this hub? Is it, I mean, how many regions or countries are you looking at covering, and what is it going to look like eventually when it is fully operational?
So, thank you. In Sub-Saharan Africa, Citi has a physical presence in 15 countries on the ground: North, East, West, South Africa. In the Middle East Africa, we are in 29 countries. So when I talk about a hub, we have brought some activities here in Kenya to support not only our Sub-Saharan Africa business, where we're present in 15 countries, but to support our larger Middle East Africa business, where we're in 29 countries. So a good example is digital client support. We are a support hub for digital services for our clients here in Kenya. We are a support hub from a risk perspective. So credit risk analysis. Yeah, we have a number of bankers who sit here and support the wider region from a risk analytics point of view. Another way to look at us is as a service hub. So we support certain services here like credit risk management, which again supports the broader 29 countries. And we support also things like KYC for customers out of Nairobi. So the growth of Citi Kenya is not just growth on the business side. We are also an important service hub that supports other Citi entities. So that's the explanation to you as to what we do over and above our banking business. Over and above our banking business, we're a services hub, and we're also a risk hub to the broader Citi network, particularly around the Middle East Africa region. I hope that explains it.
Yes, it does. As we conclude, what is your parting shot?
My parting shot is for the banking industry to step up to the table and hear the cry of customers, be responsive to the initiatives that are there underway, whether it's passing along the reduction in interest rates to our customers, supporting our customers with credit extension to the private sector, essentially grow that, and three, just contribute to a more resilient and sustainable banking sector, financial services sector in the long term by how we operate. So it's again just the principles of customer centricity, passing on value to our customers, and making sure that we are contributing to a more longer term sustainable financial services sector. Big part in short, but I think it's the appropriate one to close the conversation.
Thanks a lot for this opportunity. Now, and that is it in Thought Leaders Chat with Ochieng Olo. Today, my guest was Mr. Martin Mugambi, the CEO of Citi Kenya and the banking head. Thanks a lot for watching.
Thank you, Ochieng.
Thanks a lot.
Thank you.
Yes.